Hey everyone, we're here with Antonio, the CEO of Dydx. He'll be doing a talk on scaling liquidity and decentralized trading on layer 2. And I'll let him take it from here. Antonio, can you just confirm with the audience they can hear you before you guys?
Yeah, absolutely. Can you guys all hear me? I'll take that as a hopeful yes. So yes, hey guys, I'm Antonio, the founder and CEO of Dydx. And yeah, I'll be talking about our plans for layer 2 today. Also, if you guys have any questions, feel free to ask them at any point. I'd love for this to be really interactive and just kind of focused on whatever you guys are most curious about. So feel free to just shout them out in the chat at any time and I'll get to them. Okay, so first of all, what is Dydx? Dydx is one of the leading decentralized exchanges for perpetual contracts, margin trading, and then spot trading. And I'll go through what each of those is kind of in turn. So our kind of bread and butter, the thing we're mostly focusing on is perpetual contracts. Perpetual contracts are just a derivative product or basically a synthetic way of trading cryptocurrencies or any asset for that matter. But they've become really popular in cryptocurrency. Perpetual contracts just over the entire market are by far the most popular financial product in cryptocurrency. They have more volume than kind of the entire rest of the market put together. And YDX is one of the leaders in terms of bringing that product to DeFi. This is basically, it's pretty financially similar to if you've traded on BitMEX or Binance or anything else like that kind of offer these types of products. And that's the thing we're mostly focusing on. And then next we offer margin trading. Margin trading is kind of similar to perpetual contracts, but instead of using a synthetic derivative contract to obtain leverage, you basically will just borrow funds to kind of trade with more funds than you would otherwise be able to. And it also allows you to go short certain cryptocurrencies as well. And then finally, we offer spot trading. Spot trading is just a fancy word for regular old buy and selling, but we offer that on the product as well. So that's kind of where we're currently at right now. If you haven't yet, you can check out the product at trade.dydx.exchange just to kind of follow along as well. Okay, so where are we at right now? I'll go through just some of the limitations that we have. And a lot of these, well, basically all of them are kind of due to us being like every other DEX basically on layer 1 Ethereum right now. So the first one is certainly not news to anybody who's used DeFi before, but fees are really, really high. Just obviously, the Ethereum blockchain has become pretty congested, especially in the past couple months, and this has led to just really high fees that we have to pass on to users. Oftentimes it'll take about like $5 or $10 in gas fees to execute a single trade on DYDX. Sometimes even higher based on kind of the gas fee environment. But this is obviously a really big problem for us and traders as well, of course. It's just pretty tough for especially non-whale type holders to use decentralized exchanges when the fees are really, really high. So second of all, speed. So I'd say we're in a pretty similar boat here. I like to think that DYDX's UX is one of the most forward-thinking in DeFi, and I like to think one of the best. But still, we're kind of, again, limited by the speed of just the layer 1 blockchain on Ethereum that we're building on. So, if you've made a trade on DYDX, it's kind of similar to any other DeFi app that you may have used, where it's like you make a trade, then there's basically a spinner or like pending state on the app for the entire time until your Ethereum transaction gets mined. So you kind of just see, maybe you want to go 5x long on DYDX, you go ahead and do that, and then you just see a pending state for like 30 seconds or a minute after that, which is not an optimal UX. If you were using a centralized exchange, you'd click trade and just immediately your balances would update. But we're not quite there yet. So the third one, and this is a little bit more financially complicated, but I'll go through what this means, is that perpetuals on DYDX right now only support isolated margining. And basically what isolated margining is, and what margining basically means, margin is just collateral. So that just means if you want to trade some of the leveraged products on DYDX, you've got to put down some collateral to basically back your position before you can make a trade. And right now, like I said, perpetuals on DYDX only support isolated margining. Isolated just means that for every market on DYDX, you have to put down collateral separately for that market. So say you want to trade on both the DYDX Bitcoin perpetual and the DYDX Link perpetual, and you have $2,000. Well, you've got to put down, say, like $1,000 to back your BTC position, and then a separate $1,000 to back your Link position. So it's kind of like you need, roughly double, or it's not exactly double, but you need like a lot more capital to basically back all of the different positions you might want to take on all the different assets on DYDX. So this is a pretty big problem for traders because it just really limits capital efficiency. This is especially bad for market makers. So imagine you want to provide liquidity on DYDX, you're a market maker, you love DYDX, and you just want to market make all the different DYDX markets. Well, basically what you have to do, again, because we have isolated margining, is you've got to put down your capital, like I was saying before, for every single market on DYDX separately. So say DYDX had like 50 markets, you'd have to put down collateral 50 times to start market making on each one of those markets. And this is just obviously really cost prohibitive for market makers. And this is the main reason why DYDX still to this day doesn't really have that many markets. I think we only have like 4 markets or so right now, as compared to like a Uniswap or most centralized exchanges, which have, 50 to like up more than 100 or so. So that's been a pretty big limiting factor for us. And then the last limiting factor is maximum leverage. So this basically comes down to price oracles and kind of their performance on Ethereum. So DYDX, like a lot of other DeFi protocols out there, plug into price oracles. These are oftentimes really slow. Well, basically, actually, they're always really slow. Basically, if the price actually changes of an asset, then it takes a lot of times minutes, up to about like 15 minutes or so. We've seen in the worst cases for those price changes to actually be reflected on the price oracles. And this is just a really big problem if you're trying to run a leveraged product exchange, because basically you have to have a lot higher collateralization ratios, which translates to lower maximal leverage that you can offer customers because of these really high latency price oracles. So I'd say these are 4 really big UI and other challenges that users of DeFi in general, but especially on DYDX, face right now. So to fix all of these problems, basically what we're doing is we're integrating with Starkware, which is one of the leaders in terms of building blockchain scalability solutions for a layer 2 integration just for DYDX. And I'll go through this entire integration and how it's going to work in a lot more detail later. But first, let's start with all of the advantages that we're going to get based off of this integration with Starkware. So all the 4 things that we just saw were limitations are actually going to become way, way better in this system with Starkware. So first, fees. This is probably not news to anybody, but obviously the whole point of layer 2, or not the whole point, but a really big point of layer 2 is just that gas fees will be way, way cheaper. They should be at least 100 times cheaper on our integration with Starkware, and we can basically pass on these savings to traders. The fee should be very in line with what you'll see on centralized exchanges on DYDX after we do this integration. And that should be awesome for traders, especially smaller traders, because what we've had to do right now is we've had to basically minimum out the fees that you would pay on DYDX at a flat amount. So at like that $10 amount or whatever the gas fees are currently costing us. So if you're trading with a small amount of money, this is just really cost prohibitive. But after our layer 2 integration with Starkware, again, DYDX should be a lot more accessible to traders with all different sizes of capital. Next up, speed. So another thing layer 2 is great at is just making sure that the trades happen and are executed much more fast. So on the UI, it'll update immediately once users have trades. So after you make a trade, it'll feel like a centralized exchange. Your balances will be immediately updated, your funds will be immediately withdrawable, and the UI should just overall feel a lot snappier and a lot more what you're used to from trading on various centralized exchanges. Next up, margining, and this is actually a really big one. So I kind of talked about what this was before in the previous slide, but we're going to be building a cross-margin system for perpetuals on our layer 2 integration with Starkware. And what cross-margining is, it kind of sounds like a fancy word, but all it means is that you can just share collateral across any different perpetual market you might want to trade on. So now in our example, where say you want to trade on both the Bitcoin perpetual and the Link perpetual, you could just put down your $1,000 worth of collateral, and that would back both of your positions. So this will vastly increase capital efficiency for traders. Just will mean that you can take bigger positions with lower amounts of collateral on the system. And much more importantly, it'll open up a lot more avenues for launching new markets with market makers. So I kind of talked about this again before, but market makers, the isolated margining is a real hassle for them because they have to collateralize all their positions independently. But now they can just have one pool of capital and they can start quoting on every single DYDX market at the same time with just a really small amount of capital. And this is what's going to allow us to launch many, many new markets on DYDX. So in the year following launch, we're planning to add about 25 to 50 50 plus markets on Dydx, up from the 4 that we have right now. So just multiple orders of magnitudes more markets that will exist on Dydx after this integration. And then finally, maximum leverage. So what we're going to do is we're going to put Oracle prices on layer 2. And again, because of the speed and much cheaper fees that we see on layer 2, the Oracle latency, which is basically the time from which the price of an asset actually changes to whenever it's reflected in the system, will decrease by at least 100x. And this will allow us to just safely offer much higher maximum leverages. And what, again, more in line with what you'll see on a centralized exchange. So it sounds pretty great, but let's kind of look into how it'll actually work under the hood. And again, if you have any questions as we walk through this, feel free to shout them out in the chat. Okay, so first of all, the way Dydx works right now, and the way it'll continue to work after we have the Starkware integration, is Dydx is what's known as a hybrid exchange. And that means we have some decentralized components. And these are, of course, the smart contracts, which run on the blockchain, which custody everyone's funds, things like that. But we also have some centralized components to the system. And the main centralized component that we run is the matching engine. And running this matching engine in a centralized way allows us to offer much, much more performant trading to traders already to this day. And of course, this will continue into Starkware as well. You can basically get really cool things like free and instant order places, free and instant cancellations, things like stop orders, all this other good stuff that professional traders really require to trade on an exchange. And that's really due to our hybrid matching model. Okay, so first step, if you want to place a trade on Dydx after our Starkware integration, you'll go to our nice little website here. And then the first thing that you'll do after filling out how much you want to trade and everything like that is you'll cryptographically sign the order using your Ethereum wallet. And this is kind of the same as it'll be today, but basically you'll just have to, you'll come up with an order, or basically the system will come up with an order for you. And this will have things encoded in it, like how much you want to buy, how much you want to sell, what assets, at which prices, all these different things. And then you'll cryptographically sign it in your wallet. If you're at all familiar with 0x, it's a pretty similar process to that, where it's just off-chain signed orders with on-chain settlements. Okay, so now you've signed this order, and we're going to send it to our backend matching system. Our matching engine, this is really best visualized by what you'll see on the order book. Just on the order book, that's this tiny little thing here. But it's basically just all the different prices that people are willing to buy and sell at. And if there's ever a match, say you want to buy at a price that's higher than whatever the best sell offer is, or vice versa, then we'll actually execute a trade for you in the system. And this is, so far as like on the matching engine, pretty similar to what you'll experience on a centralized exchange. So, okay, now our matching engine has your signed order. Say you match to somebody else, which basically means that, okay, now you should trade with this person because you've matched with them. So the matching engine will come up with a trade. And all the trade is just a combination of your signed order and then all the signed orders for all the different makers that you've matched with on the platform. And this is pretty similar to how it works right now. Basically, if we were to look at this system right now, before Starkware, we could just kind of X out this whole middle Starkware section, and your trade would just go directly to Ethereum. And that's where all of our gas costs come from right now, just executing these trades, verifying the signatures of all these orders and things for every single order on the chain is quite expensive, as you might imagine. But now we have this trade, and instead of sending it to Ethereum, we're going to send it to Starkware. And what Starkware is going to do is it's going to batch the trades in its memory. These trades don't actually go on the blockchain one at a time anymore. They get batched together, and kind of eventually these batches of trades will all get submitted to the blockchain. So we have this trade 5. Say there were 4 trades that are sitting here in this batch that are waiting to be executed on the blockchain. And these will just kind of sit in memory on Starkware system until they're executed. The next thing that happens is this, and this is kind of the magic of Starkware. So periodically, Starkware will take these batches of trades, and then they'll convert them into a Stark proof. And I'll talk about what this is by using just a proving engine. And what this Stark proof is it's pretty cool, and it's pretty mathematically magical, basically, because you can take this batch of trades, and it doesn't matter how long it is. There could be 1 trade in it. There could be 10 trades in it. There could be 10,000 trades in it, or potentially even more. But the important thing and where all the scalability comes from is that all of these trades get translated into this constant size Stark proof object. And this proof, what it's proving is that all of these trades actually happened. They were all agreed to or signed by all of the different counterparties. They all met, say, the collateralization ratios of the different markets, things like that. People actually have the funds in their accounts to meet these collateralization ratios. All of this is proved in this really small constant size Stark proof object. And that's kind of the magic of Starkware system and where all the scalability comes from. And Starkware runs this proving engine right now for us. So they're the ones taking this batch of trades, doing their math magic. Even I don't fully understand all of it. And then they translate it into a Stark proof. So now we have this Stark proof. And the next thing that happens, and I guess the final thing, is that this Stark proof is just put on the blockchain by Starkware in an Ethereum transaction. So now instead of, remember before we were taking every single one of these 5 trades and submitting them independently to the smart contract on the blockchain. Now all we have to submit to the blockchain is this constant size Stark proof object. And the smart contract on the blockchain, and this is the last really cool part, but the smart contract knows how to verify this proof. So it knows how to basically tell if this Stark proof is valid or not. And once this proof is submitted to the chain, it's immediately final. So the smart contract will accept it. It'll verify the proof all in one transaction. And then the balances of every single user on the entire platform that made a trade in that batch are updated immediately. They're all withdrawable immediately. So just to recap, the kind of process of placing a trade is, you place it on the UI, gets routed to our matching engine, gets queued by Starkware for a little bit in their system, and then it gets batched with a bunch of other trades on the system. And then Starkware comes up with their Stark proof, and then that's eventually submitted to the Ethereum blockchain where the smart contract verifies that the proof is valid. So that's the entire process. Again, if anybody has questions on this, would love to answer them as well. You can also come back later. So next up, I'll talk about why did we choose to integrate with Starkware over some of the other scalability solutions that are out there. So the first one I just mentioned, but it's actually really important, and that is instant batch finality. It sounds complicated, but all that means is that once you submit one of these batches, and remember that's just the constant sized Stark proof object that we're putting on the blockchain, but once you submit it to the blockchain, because the smart contract can mathematically verify that the proof is valid or not, then everybody's balances can be updated immediately on chain. And this is actually pretty different than a lot of other scalability solutions that are out there. The biggest one that is kind of one of the competitors to Starkware, I'm not speaking on it too much, but it's basically optimistic rollups. Probably a lot of people have heard about this, but on optimistic rollups, you kind of submit basically the same batches, or you submit these transactions on layer 2, but they're not actually final for a really long time. Or on optimistic rollups, basically the kind of batch submitters, if you will, it's a little bit different, but it's kind of a similar idea. They can basically submit whatever they want. And then the optimistic part means that the smart contract will accept these changes no matter what they are. But all of the kind of basically the health of the system comes from the fact that then there's some period where anybody can watch the changes that this submitter is making. And again, this is on optimistic rollups, and can basically challenge them on the blockchain. But because of this need for a challenge period, and challenge periods can oftentimes be a day or up to a week, it means that changes on an optimistic rollup system are not final for days or weeks at a time. Whereas with Starkware, once the batch is submitted, that's it. It's mathematically verified. Everybody can withdraw, everything else like this. So one of the things you can do to basically get around, maybe taking a step back, but one of the problems if you don't have finality in your system is that you can't withdraw from the system until the batches or transactions on layer 2 are considered final. Because on optimistic rollups, they have to go through, again, this challenge period. And you can't just take funds out without it going through this period. So that kind of means there'll be delays of days or weeks or for an optimistic rollup system, or even on the Stark rollup system. If we didn't have fast withdrawals, and I'll go through what that means in just a second, then basically people would have to wait for kind of the batch submit time to actually withdraw their funds. And Frank, actually, yeah, that's a great question. So Frank asked, how often does the Stark proof get put on Ethereum? We're still figuring that out, but it'll probably be about 15 or 30 minutes or so. But you won't have to wait 15 or 30 minutes to withdraw your funds on Dydx. And the thing that you can do is basically you can have a centralized party which kind of fronts the withdrawals. So say, Frank, you want to go and withdraw your funds from Dydx and you want them now, you don't want them in 30 minutes. What Dydx can do is it can basically front you all of the money that you're about to withdraw. And then Dydx can get reimbursed, and this is kind of cryptographic, through once your funds are actually withdrawn, they can, instead of being withdrawn from you, they can be withdrawn to Dydx, and then Dydx would have already fronted you the money. So you can kind of use this central liquidity provider model to actually make a lot of these withdrawals a lot faster. And you can do this on both Stark rollups and optimistic rollups too. But the thing with, say you want to consider being one of these central withdrawal providers or central capital providers, basically the amount of capital that you have to have is proportional to how long the batch submit time is, or the finality time is, times how, or basically like how much people want to withdraw during that time. And this amount is much, much lower. Say all the funds that people want to withdraw on Dydx in 15 minutes versus like all the funds people might want to withdraw on Dydx in a week is like way, way higher, obviously. So that's the first and really important benefit. So the second benefit is it doesn't rely on fraud provers. So I kind of touched on what optimistic rollups were before. And I'm a big fan of optimistic rollups, but one potential, theoretical issue with them is you really need to trust that people are watching the system and are incentivized to submit these fraud proofs on chain if the central party is committing fraud. So Stark rollups don't rely on any game theories, just pure math. And they're also computationally expensive to do fraud watching. Say you want to watch you want to be like a fraud prover on optimistic rollups, you have to watch every single transaction for the entire system and process every single transaction for the entire system in order to tell if anyone is committing fraud or not. And then the third one, and this is actually really, really important, but Dydx obviously is running a production exchange right now. We're doing a lot of live volumes. So we need a scalability solution which is production ready. Starkware is already live with Diversify. Diversify is just a really good spot exchange, spot decentralized exchange. So what they built for us is a little bit different than what they have with Diversify, but they have a history of just being able to ship just really high quality scalability solutions, and we've seen them run in production already. And our plan is to have this live with Starkware in a little less than 3 months. Our entire team, engineering team, is working heads down on this, and a lot of Starkware's team is working on it as well. So this was, in our opinion, one of the fastest ways for us to get into production with a scalability solution. And then the last one is just it's an Ethereum-based rollup. So this is as opposed to, say, if we were to move to a totally different layer 1 chain or things like that. So this means that the rollup settles on Ethereum, maximizing its decentralization. So it's basically, as decentralized as Ethereum is, at least from like the non-custodial perspective. And then we also have access to the Ethereum-based DeFi ecosystem. So it's going to be really easy for people to transfer their funds in and out of the system because it's just based on Ethereum. You can have it custody ERC20 tokens, all of that. You can use Ethereum wallets, all of that good stuff. So one more question before we move on. That's a good question. So why do we have to rely on Starkware calculating the proofs rather than doing it ourselves? This is basically just Starkware's bread and butter. This is like what they know how to do. And these zero knowledge proofs are very, very complicated, mathematically complicated. And there's only, honestly, probably a couple people in the world that know how to construct them. So this is the main reason why we're working with Starkware. They have this expertise to be able to construct these proofs rather than us doing it ourselves. But from the user's perspective, it's more or less the same. It's just we'll be running on Starkware servers as opposed to ours. So, and I kind of touched on this before. I guess we have about 5 minutes left now, but this is the last slide. So if you have any other questions, feel free again to ask them in the chat. But we are launching this with Starkware in about 3 months from now. So pretty fast launch time. Touched on this before, but we're going to roll out a ton of new markets after this, probably on the order of 25 to 50 or potentially even more markets in the year following the launch, which we're really excited about. and then the UI and API, if you're a programmatic trader, will be vastly improved after this. Where in addition to implementing Starkware, we're building an entirely new backend architecture for our exchange, which I guess I'm kind of excited about because I'm a backend engineer by trade. But I think it will be a lot better experience for API traders in addition to the people who use our UI as well. And then we're rolling out an entirely new UI, which will be totally redesigned, and new API alongside the launch as well. Yes, Frank, good question. So I kind of glossed over this before, but one question is, where do the Oracle price feeds for layer 2 come from? And are they using Chainlink? So maybe I'll just start with what the state of Dydx's oracles right now. So Dydx integrates with a couple different Oracle providers right now. We integrate with MakerDAO's V2 Oracle system. This is the Oracle system that powers Dai. And then we also integrate with Chainlink for our link market. And then we actually have our own Dai price Oracle as well, because nobody really has that yet. But on layer 2, what we're going to do is we're going to use the exact same Oracle systems that we have integrated with right now. So we're not building our own like Oracle system from the ground up or anything like that. Chainlink is looking into potentially supporting Starkware signatures for layer 2 price oracles, which we're really excited to work with them on, hopefully. MakerDAO is committed to doing this. So it'll probably be some combination again of Chainlink and MakerDAO Oracle prices that are going through the system. Yeah, so one of the, I guess, limitations of perpetuals right now is that we are not able to offer them to US-based traders. Certainly not now, probably not in the future either, or there's no plans to actually be able to offer this in the US. I'd say, yeah, this is probably just, this is not legal advice or anything like that, but it doesn't really seem like there's a path to offering perpetuals in the US. So we're not so much looking down that option. Do we plan on becoming a registered DeFi exchange? I guess registered kind of means a lot of different things potentially to a lot of different regulatory agencies. We certainly do a lot of work on the legal side to just look into all the laws to hopefully understand them to the best of our abilities and be compliant in all of the jurisdictions that we offer. But kind of like I just said, on the CFTC side, and the CFTC is the regulatory body in the US which regulates derivatives, there's just not really a path to being able to make perpetuals, at least regulated in a compliant way in the US. So we don't have plans to do that right now. Of course, there are a bunch of other regulators out there like FinCEN, like the SEC, things like that. And then we kind of deal with those on a case-by-case basis. But thanks for all the good questions, guys. Cool, so that's kind of the entire presentation. I guess we have another minute or two if anybody else has any questions, but thanks so much for kind of listening to the presentation. I think my colleague David has a presentation a little bit later today as well on just scaling liquidity at Dydx. I think that's a pretty interesting topic as well. We run an order book based model as opposed to like an automated market maker or things like that, which means that we have to deal with a lot of different market makers and then try to work with them to build liquidity on the platform. But the way we've kind of gone about that and the things that we've seen be successful versus not, I'd say are pretty interesting and could be useful for a lot of different use cases as well.
Cool. Well, this was great. Thanks so much for taking the time.
Yeah, absolutely. Thanks so much for having me.
Yep. All right. We're going to transition to our next talk now. Thanks.